There are a variety of factors that are contributing to questions and fears about our banking system nationally. In light of a recent banking failure in California, we will be looking at the state of our banks locally. That's next on WNIN Newsmakers. I'm April Nading, filling in for Amy Mangold. A few recent banking crashes in California have left some individuals nervous about the state of banking nationally. Here to provide information on the matter locally is USI accounting professor Dr. Thomas Nolan. Thanks so much for being here.
Well, thank you, April, for having me today.
What do you think are some of the major factors that actually led to the bank failures in California?
Well, the California failure is not like a normal bank failure. It was a crisis of liquidity. The depositors started pulling their money out of the bank. Now, as you know, the FDIC insures deposits up to $250,000 per individual. Now, that's not saying you and your spouse can have more than $250,000 in the bank. In fact, there's ways to get about close to $1 million of insured deposits through trust, IRAs, joint accounts, and that type of thing. But the large commercial depositors do have a lot of uninsured deposits. If you look nationally, I would say the FDIC, about 57-58% of all deposits are insured. At Silicon Valley Bank, less than 10% of the deposits were insured, so over 90% were uninsured. So as people felt like the bank may be failing, they started pulling the deposits out of the bank. Now, typically banks fail due to asset quality. If you go back into the 1980s, commercial loans went bust, the oil fields went bust. You go into the 2000s, 2008s, there was a mortgage crisis. Banks lent a lot of money to bad borrowers who didn't repay their mortgages. But at this time, it was really just due to what happened was the interest rates on debt. Interest rates were basically 1%, now they're 4%. So the price of your bond will decline. So as prices of the bond declined, and I don't want to get too technical here, but those securities were held in what we call held to maturity accounts, which doesn't affect the bank's capital unless you have to sell it. They're called unrealized losses. So unless you sell it, then it becomes a realized loss, but people saw that the value of those bonds were declining and so started pulling their money out, and the Federal Reserve did not act quick enough to increase the borrowing capacity at the Fed window. They did the following week, but they didn't that week, and that led to the ultimate closure of Silicon Valley Bank. And there was a couple other banks had some crypto issues, had a lot of crypto deposits up. Signature Bank was one, but both of those were old-fashioned liquidity runs on the bank. And think about this compared to 30 years ago, when I worked for the FDIC many years ago, you had to go into the bank and get your money out. Well, right. Today I can press a button and transfer millions of dollars, so it's much easier to have a run on the bank than it was, say, 30 years ago.
It makes it happen a lot quicker.
Happen a lot quicker. You have to react quicker. So, anytime a bank fails, it's first a failure of the board, of the management and the board of directors. But in this case, I do think the regulators have some blame as well.
So I was going to say, you were saying really if they had caught it sooner, if the feds had acted quicker, they could have.
They may have been able to save the bank. I'd have to look deeper. I think Congress has asked for an autopsy, quote unquote, to be done by 1 May and report back. So, assuming they had no other asset quality issues, and it was just this issue of the declining in the price of their bonds, they could have survived if the Fed had acted quicker.
How would they have known? I guess without getting too technical.
Well, you file a call report quarterly with the bank regulators. So the bank regulators have some idea of where you stand. They also have an examination team that normally comes in a bank that size at least once a year. And I don't know if this was the case with Silicon Valley Bank. Some of your larger banks have in-house examiners that actually work there every single day. Oh. They're at the bank every single day, for the Bank of America, JP Morgan Chase. So, but I don't know if that was the case with Silicon Valley Bank. So they were aware of some of the issues. Nationwide, there's been an increase in deposits the last couple of years. But, as people say, well, my deposit's uninsured, I'm going to move it to somewhere else and that type thing. So they just pull the money out, and then that forces you to sell your assets. And in this case, when they had to sell some of their assets, they had to take write-downs on their securities portfolio.
Is it a good thing that the deposits have been higher than normal?
Well, part of that's the federal government stimulating the economy with the COVID money. So the deposits have went higher. The times have been relatively good, for the last few years. So it's good that the deposits were growing, but now we may see a retrenchment in that in deposits. But the average borrower has nothing to worry about. If you're Joe Blow on the street, you say, oh, my bank failed. Well, you'll get your money the next week. You may not get. Usually, the FDIC will shut down a bank on a Friday, and by Monday it's reopened in a different name, or the FDIC has taken over the bank, and so you'll get your money in short order.
Which I think that's what probably concerns a lot of people. You start wondering, is there anybody even looking? Do the banks just kind of operate willy-nilly? Without, and they can't do that. Every bank has to have this.
Every bank has an examination. Some banks are on, say, maybe an 18-month window. And I'll go back up and talk about bank regulation a minute. Some banks are supervised by both the federal government and the state, and that was the case with this bank. The California, and I don't know the official name there, but basically the California Department of Banking and the Federal Reserve were what we call the primary regulators of the bank. It was called a state member bank. The FDIC is still the insurer, so it also has backup regulatory authority, so it really could have been overseen by 3 regulators, but it still failed. But now some banks are overseen by the state and the FDIC as the primary federal regulator, and some have what we call the Office of the Comptroller of the Currency. If you're a national bank, the OCC, Office of the Comptroller of the Currency, will be your primary regulator, and the FDIC will be your backup regulator.
Okay, it's a lot.
But banking is highly regulated. And of course we've had 3 banks fail this year, but the previous couple of years there were no bank failures in the United States at all. So it's not like the situation where we had in 07, 08 through 10. Probably, I don't remember how many banks failed in that era, but I know at one point about 800 banks were listed what we call on the FDIC watch list. Mm-hmm. I think today, at the end of 2022, there might have been 45 to 50 banks on that watch list. So we're nowhere near what we were in 2008 through 10.
So that was one of my questions, was when do people need to start not panicking, but really being concerned? You're saying 2 or 3 isn't, it's still not good, but it's not that big a deal to.
The FDIC, has an insurance fund. People may not know this. The FDIC is a separate funded government agency. They charge banks insurance premiums, just like you pay an insurance premium on your car or house. Banks pay into the FDIC insurance fund. The first thing that will happen is, that insurance fund will pay out any deficiencies. And then if the FDIC needs to, they can go borrow money at the U.S. Treasury. And they have done that in the past, but all that money has always been repaid. So no depositor has ever lost a dollar of deposit insurance. FDIC was created in 1933 as a result of the Great Depression, the bank failures in that era. So, it's varied over time how much deposit insurance there is. It's currently $250,000, which is, some are calling for an increase. But if you look at France, both my daughters have lived in France. I think maybe it's 100 euros there. So a joint account could, a couple 100,000 in euros. So we're actually higher, and I think the Bank of England might be a little less than that, a little less than 100, maybe 80, 85,000. I don't know what it is now, but so most, governments have some form of deposit insurance, but the U.S. is $250. If you've got more than that, go to a different bank, go to a credit union, so.
And I guess one of the concerns is, can something like what happened in California happen here?
Could it happen here? It's unlikely we would have a run on the bank. What we may see here or in some of the, say, New York or Chicago, interest rates have went from, basically you could just take your house loan, you could borrow money at 2.5, now it's charging you 6. As interest rates reset, some commercial businesses may have some difficulty repaying their loans. If you're a bank sitting with a commercial office building, now people are working from home. Let's say I'm a let's say I lease in that building. I used to lease 4 floors, now I lease 2 floors. Well, if that's all I'm going to lease, that owner of that building's got to find somebody else to occupy the building. Well, if they can't find somebody, well, can they repay their loan? So you may see some of that shake out in, say, New York or Chicago. I don't think that'll happen here in Evansville. But so you may see some of that over the next couple of years. We'll see what happens as these loans reprice. More people working from home, so you don't need that 4 floors. You need 2 floors now in that office building.
Right. Now, kind of go back to, you touched on credit unions.
Okay.
Is that something that people should think about when they're banking? Does that make any difference?
A credit union also has a separate insurance fund that can be drawn on. Some credit unions are fairly small, so others are functioning more as a similar to commercial bank. There are certain lending restrictions on a credit union, as you know. But yeah, credit unions in this area have done a good job. There's a lot of credit unions here, so keep some money maybe in a credit union, some at a bank. If you're at that, if you think you're at the risk of, over the $250,000 limit.
Well, what should people keep in mind to try and avoid something like this happening? One of the things you said was that people became nervous, they started taking out their money. So what should people be doing to keep track, maybe to know if they should be taking out their money?
I've always said, let's just say you're a small business and maybe you got your payroll at a bank. I've always told my students, and I saw this when I worked at FDIC, you're better off dealing with a couple of different banking institutions. Not so much on the deposit side, but it could be on the deposit side. But any bank is willing to lend you money when times are good. Mm-hmm. When times aren't good, the banks will say, well, we're not going to renew your loan. Well, you got to get somebody else to take out that loan, or you're going to default perhaps. So I've always said, if you're a commercial business, make sure you got a couple of banking relationships is my best advice to the person who owns a small business. As an individual, I've got some money at banks. I've got some money at some credit unions. So, you can just spread your money around a little bit, and you're going to be totally safe as far as your insured deposits.
Now, I've never heard that advice before. So I guess my question then would be is, as far as how much money? Is it if you have more than $10,000, you should have them in more than one?
No, if you're small, but I'm talking about people who are borrowing, millions of dollars on a loan for some reason, and then, like I said, the loan's coming due in 4 months. Well, you're not bringing in as much income as you did in your cash flow, so we don't know if we're going to renew that loan. So if they don't renew the loan, you owe the bank, and they can come get your collateral, your building, or whatever. So I've always said, maintain a couple of banking relationships if you're a small business owner.
Okay,
and people define small business some way. Some people say, well, small business is Joe with 100,000. Some say it's somebody borrowing several $1 million. So you can define. Years ago, a big bank was anything over 10 billion. Now it's over 100 billion. So it just depends on how you want to define small versus big.
Right. So for the average person, though.
Yeah, the average person has nothing to worry about. Don't panic. If you read something in the newspaper, don't go down to one of the banks here in town and try to pull your money out or anything like that.
We don't need to have runs on the bank.
No, I don't think there'll be any runs on the banks here in Evansville.
Okay. Well, thank you so much. I think you've cleared up a lot and maybe help ease people's minds on what's going on.
Well, thank you for having me today.
You're welcome. Individuals may also be concerned about the state of their current investments. Here to provide insight on the matter is Kim Wren, a financial advisor with Berger Wealth Services at Baird. Thank you so much for being here.
Glad to be here.
So what do you think is the overall health of the financial industry right now?
Yeah, it's hard to find a comfortable place these days. I don't think it's any secret that we're facing some volatility, a little uncertainty, especially with recent bank troubles that we've been hearing about in the news. Overall, it's an interesting place to be because we're seeing interest rates go up in order to try to combat inflation, our year-to-year cost of living. But then at the same time, we're also in a historic low unemployment rate. So everybody who's looking for work is finding it. Mm-hmm. And we've been hearing kind of talks of a recession. It seems like there's been a recession looming a week away for the past 2 years. So,
yes.
So we're kind of in this really mixed space. Nobody's really having any strong opinions about exactly where we're going next. So there's just a lot of uncertainty baked into the market right now.
So I guess the problem is, like you were saying, they've been talking about this recession that's been looming for years.
Right.
Does that make people a little more complacent, that they just don't even pay any attention to it?
You know, it depends. So we have some investors who said, I'm just going to ignore my statements and just kind of ride it out and think long term. And some folks are just a little more squeamish, and they need a little more hand holding through seasons like this. And so the advice is just to get good advice, get good professional advice, and to stick with that advice. Try to think long term and ride the waves.
So find an advisor that you feel comfortable
Exactly.
with and that you trust.
Exactly.
Has the banking crisis in California affected the stock market and investments? What's your opinion on that?
Yeah, certainly. So after the news came out of the banking crisis out in California, bank stocks took a pretty big tumble, lost a lot of favor with investors, understandably so. So it depends on your perspective, though, April. Some people see declines in prices like that for companies that are quite strong, like the banking industry, as buying opportunities, buying stuff on sale, versus a time to panic. So it all depends on your perspective. Some people hopped out when they heard of shaky news, and some people hopped in to try to bet on the long-term growth of those companies.
So kind of what is one person's loss is another person's gain?
Exactly, that's how the market works. Exactly.
Well, have you noticed any trends locally that may have been affected by the crash in California?
Thankfully, I think that our local economy has fared quite strongly. We have a number of regional banks and local banks that are very important to the tri-state community, household names, and I personally work with do my personal banking at a local regional bank and a local credit union, and have found that day-to-day operations are going on as it's just kind of business as usual. The same people I see on Friday afternoons making their regular deposits and withdrawals are there. The same tellers are there to greet me. And when I go to withdraw cash to do my day-to-day business is there. So thankfully, I think our local economy is faring well, despite some of the uncertainty. Some people are flocking to the bigger banks just for the perceived safety. But overall, I think that our local economy is faring quite well.
What about, do you think there were some people, though, who decided maybe I don't need a bank at all? I should just take my stuff out? And
certainly, we have the under the mattress type folks, and the gold bars in the backyard type folks.
In the jar. And
Exactly. I think my grandmother was one of those folks as well.
I've had relatives who've done that.
Absolutely. It depends on where you're willing to take risk on. So I know that FDIC insurance has been kind of the talk of the town recently, with how much of somebody's bank deposits are covered federally. And so you can take on the guarantee of the federal government or the backing of the federal government that your deposits are safe inside of these banks because of the FDIC insurance, or you could take on the risk that I'm going to bury it in the backyard and hope nobody knows that it's there and comes and takes it. So, it all depends on where you're willing to put risk. Most investors end up working with a long-standing, high-quality financial institution.
Well, I guess using the word risk is something that people need to think about. Is it a risk to have your money in the bank? And
right.
I'm hearing no, it's riskier to have it in your backyard.
Sure, it depends on the perspective. The FDIC insurance is a very important component to help to undergird the financial system in the U.S. And there have been talks about, because of recent banking troubles, is it time to increase the limits of FDIC insurance? So for the most part, most everyday folks, with the limits being $250,000 per person per institution, most folks just don't need a cash level that goes beyond that for their day-to-day household operations. Some do, and there are solutions for those folks that are out there and those businesses that are out there. But for most kind of everyday people, that $250,000 insured limit for a single depositor per institution, so remember you could spread that out across multiple banks and get that $250,000 limit across multiple banks and kind of stack that on. For most people, their coverage is going to suffice their household needs.
So they would get all of it back?
In theory, yeah, that's what the insurance program is for. And we saw even in the recent bank failure, because these specific banks were so economically important, that the U.S. Treasury Department, FDIC insurance, and the Federal Reserve all came together to say, okay, we're going to insure depositors even beyond that limit. So they went above and beyond kind of what they said they would do on paper, according to the insurance policies, in order to insure those depositors. Can't guarantee that would happen with every bank in the future, but that's what our tax dollars go towards, to get the advice and the guidance of our economic leaders in the country, and that's what banks pay FDIC insurance premiums for, to protect depositors in case of their own bank failure.
So there is a good reason we pay taxes.
There is some good reason. It's not fun for anybody, but sometimes good things come from it.
Well, are there resources for individuals to keep up to date on local news and events that may impact the financial industry? I mean, what do you suggest people do to just stay on top of things?
Well, you didn't pay me to say this, but if you're not listening to Morning Edition on WNIN, you're missing out.
All right, you heard that.
So this personally where I get a lot of my, my day-to-day news. So I think local radio, public TV is a great place to get to stay updated. And then again, it's a season to really lean on high quality professional advice. So professional financial advisors, bankers, private bankers, especially if you're a small business, because they're going to have more tailored solutions for your situation. So look to the professionals for guidance.
Well, do you have any kind of checklist? I mean, a simple thing that maybe people should know, like how do they know that they have a good financial advisor? Or
Sure. So a couple of places to check. If you're just wanting to vet that your person is qualified, has all the right licensing, there's a website called Broker Check, where you can check for your financial advisor's history, their licensing, any sort of disclosures or any sort of dings they've had on their record. You can check at Broker Check. For anywhere you're doing banking business, you can also go to the FDIC insurance website and just check that your financial institution is actually covered by FDIC insurance. And for your investing institutions like Baird, the company that I work for, you're going to want to look up SIPC, SIPC, to make sure, because there's also insurance programs for investing institutions as well to cover investors.
Could you, and that's all good stuff.
Yeah.
But could you just feel kind of confident that if it's a bank and it says FDIC, that your money is going to be okay?
Sure.
For the most part.
That's a great question. I think there is a reason to be strategic about maybe not over concentrating and not going above those limits. The FDIC insurance limits at any given one financial institution and spreading it out over multiple institutions if you feel a need to keep cash beyond that $250,000 limit. So that's kind of what I would be looking for. But you could rest assured that if that institution says they're FDIC insured, that they are, and FDIC, their website is also confirming that the insurance is there for your deposits.
Do you think maybe some of these things happening is kind of a good wake-up call for people?
I think a lot of both individual kind of depositors are realizing that, hey, uninsured deposits are in fact uninsured. So we've seen a lot of kind of cash moving between institutions, people trying to find safe places to keep their cash, especially cash that goes above the limits at any one given institution. But yeah, so that's a great point.
Because I know it made me, we walk around kind of la-di-da, everything's...
Absolutely. It's a big wake-up call. And I think it's a wake-up call, too, for the bank managers themselves, monitoring their risk and making sure that they've got the right ratio of cash on hand to cover deposits and, doing their day-to-day business to earn income on those deposits, too. So I think a lot of bank managers are kind of aware and really under scrutiny and really going to refine their business from these events.
Which they should be. We're talking about they're managing other people's money.
Absolutely.
So,
it's important. It's absolutely important.
And it's good to know that we have confident people doing it and people monitoring those confident people
Absolutely.
as well.
Absolutely.
Well, thank you so much for your time today.
Yeah, thank you, April. Glad to be here.
Thank you. Thanks for joining us to learn more about the state of banking in our area. Thanks for watching WNIN Newsmakers.